Hey everyone, happy Monday. Welcome back to another Monday market update. I'm CaitlinMcKeague. I am a real estate broker here in Phoenix, Arizona. Thank you for joining me. I am here every Monday, sometimes live, sometimes not. Today happens to be live. I am back from my conference in Las Vegas, so back to the normal background and actually get to be live this week. So excited to go through all of this stuff with you guys. If you're new, welcome. Make sure you hit the subscribe button so you can stay up to date on these market updates every week. As always, we're going to start more big picture. Then we'll talk more about Phoenix specifically and why I'm talking about a potential cold market, what those indications are for us heading that way. So if you're here live, drop me a comment. Let me know. I want to know that I'm not talking to nothing right now. So let me know if you're here and let's get into it. Let me add my screen. So what happened last week? Let's take my name off of here. Last week, we got the jobs report and the jobs came in pretty strong. And it's not super surprising that this happened. It really has not been that much change. And with the Fed hiking the federal funds rate, they're trying to slow everything down. And we're still getting a really good jobs report. So that is strong. Now, whether or not that is lagging, I mean, that's a whole other question. But for right now, the jobs report came in strong, which isn't helping the case for the Fed to not continue to raise the interest rate because they are trying to slow down the economy. Hi, Jasper. Thanks for joining. Glad you're here. So that's what happened with jobs last week. It was kind of, I don't know, good news, bad news, right? So the report showed that hiring fell from 315,000 in August to the weakest monthly gain since April. Unemployment rate dropped from 3.7 to 3.5%. So we actually had the unemployment rate drop, which was not necessarily what we were anticipating. I think the projections were that things were going to be somewhat flat, but it wasn't quite that. So that's what happened on Friday. And so I think it's later this week we'll be getting the CPI numbers. So that will continue to help us understand where inflation is at. But there's been a lot of talk lately about, are we taking it too far? So is the Fed being super aggressive, but not waiting to see what the repercussions are of their actions, right? So month over month, they continue to hike their interest rate. And that takes time, right? The effects of all of that takes a bit of time. And so there's some fears out there that they're kind of nosediving the economy without pausing for a second to see if all of their actions is actually working. And so one of those things, there's this article here that Kathy Wood says you're raising rates too high. Kathy Wood is a CEO, CIO of a company called ARC Innovation or ARC Investments. She is an advisor for investors, interviewed quite a lot about her opinion. And this is one of the things that she talks about is that specifically they're making a policy error that will cause deflation. And so that's her concern, that they've raised rates by 3 percentage points since March and has indicated that plenty more is to come. Experts anticipate a 75 basis point move at the next meeting. And I think also central banks have said, I think it was the European Central Bank was kind of cautioning the Fed on not being so aggressive and let's see where we stand with the action that they've taken so far. So as far as I know, that will continue. They do plan to raise another 75 basis points. Inflation has not changed for what we've seen so far. The consumer price index jumped 8.3% in the 12 months through August. But she maintains that the CPI is a lagging indicator. So for everything that I've heard, they're going to continue to raise the federal funds rate, which then impacts the interest rates. We are feeling that in housing because demand has dropped off significantly over the summer. And then every time they raise the interest rate, shortly after that, you start to see a drop off in demand here in terms of number of contracts. So I'm going to get into that next. So let's talk about where we're at locally. Moving on to Phoenix. And I know I have a few comments in here. Hi, Cato. I'm glad you're here. Samuel, thanks for joining. Yay. I'm not talking into the abyss today. It's good. All right. So jumping into the Cromford report, let's talk about listings under contract. And by the way, I always have to say thank you to the Cromford report. They have so much great information. So that's where I get a lot of this data that I share with you guys. So listings under contract, this is effectively our demand, right? So when you see listings under contract, that's really the activity that we have going on in our market. That's buyer demand taking up these listings and putting them under contract. And you can see this really big drop here down under 7,500. And this occurred right after the last interest rate hike. Rates are, well, they did get over 7%. I don't know where they're at this week, but that's a pretty big change. It's been a really fast change. And things started to jump back up. But I think what Cromford is saying is we're anticipating this to start going back down. And their concern, the Cromford report's concern, is that a number under 7,500 at this time of the year, when we're getting into our busier fall season, is not normal and cause for concern on how much further the market's going to move forward. Is it just going to become stagnant because we don't have a whole lot of listings going under contract? So if you're a seller out there, that is not the best news for you, because it just sounds like everything is going to continue to move slower, which it already feels very slow, right? And if you're a buyer, that is good news in some ways, aside from the interest rate, that you won't have as much competition out there and much less activity, and sellers may be a little bit more willing to sell their home at a discounted price. So that's what it means for you as a buyer or seller. However, overall the activity has just really gone down, and we'll see if this pops back up. I anticipate this line starting to go back down, especially after probably the CPI numbers come out this week and more talk about the interest rate hikes. So moving on, let's talk about the Cromford Market Index, which I know all of you guys are always here and interested in following. So if you're new here, let me give you a little bit of a background. The CMI, or Cromford Market Index, is really a measure of our supply and demand in the market. It is a leading indicator for us that tells us where price appreciation is heading. And any number that's between 90 to 110 is a balanced market. And it means that our appreciation is going to move with the rate of inflation. And if it is above 110, then we're in a seller's market and we'll have more appreciation than the rate of inflation, and opposite for a buyer's market, anything under 90. So we're at 102.5. This has fallen a little bit. There were a lot of weeks there where I just continued to talk about this being at 104, but now we're at 102. So definitely one of those things that you're starting to see a change there. What you might notice, though, is the demand index is still at 81.2. And I thought by now I would see that go under 80, but it's not. We'll see, maybe by next week. But it looks like demand is hanging on there a little bit. And our supply index is at 79.2. So basically, both supply and demand are about 20% below normal, considering 100 that normal or balanced range. So we've got under less supply than normal and less demand than normal, which puts us in balance because those are kind of matching. Now, this says we're in balance because the CMI is much more, it is not quite as reactive to what happens in the market. So the way that they have this algorithm set, it's slightly, I think it slightly lags a little bit. It doesn't get as affected quite as quickly as compared to the contract ratio, which I'm going to jump into in a second. So this is usually a little bit less volatile and a bit more positive because it doesn't show the extremes. So Anyway, take that as you will, but the CMI has been a really, really great indicator for us as it's helped guide us through the market, what's going on with supply and demand, et cetera. Now, a couple weeks ago, I didn't have this chart, but I have it for you guys this week. So here are all of the cities, the major cities in the Phoenix area, and what their CMIs are like. Again, I left this on the screen. So 90 to 110 balance. Most of these cities are under, or they're in a buyer's market. They're under the 90 mark. From Mesa and above, those are either balanced or in a seller's market technically. But you'll notice we lost one. There used to be 6 green arrows. We lost one, and I can't remember which city it was. Possibly, no, Tempe's still there. I'd have to go back and check. But now we're seeing more red arrows again this week. So again, another indication that maybe things are going in that cooling direction. We'll have to keep an eye out, but it's been maybe over the last month we started to see more green arrows coming up, and now we saw one leave. We'll see if next week another goes down. Who knows? So that's where we're at with all the different cities. And most of them, let's see, like Scottsdale didn't really have much change month over month. Phoenix, Cave Creek, those are kind of small, but Paradise Valley, that's a pretty big change. Surprise had another big change, which is not great. Poor Surprise is in a buyer's market with just so much competition with new construction out there. So many builders offering incentives that no one really wants to buy resale in Surprise, it seems like. So that's been a tough market for sellers. But that's where we're at with all of the cities. I'm going to put a comment up here. Hi, thanks for the content. I lived in Arizona since 2015, own a condo in Phoenix. Been watching the local market from afar since I travel a lot. You're a big help with that. Thank you. I appreciate that. Thanks for following. And oh no, the chart's blurry. Oh no, I don't know why it's blurry. I don't see it blurry on my end. Is it blurry for anyone else? Sorry, guys. Looks good to me. But thank you for following, and I'm glad all the info is helpful. Okay, let me get this off my screen. Let's move on. And we're going to talk about the contract ratio. I want to share that with you guys. As I said, the Cromford report says this is a little bit more, just moves with the market a bit more. So I also have a little bit of a guide here so we know what we're looking at. So here's the way the contract ratio is calculated. It is the number of listings under contract divided by the number of active listings for sale times 100. So it's basically looking at how many are available for sale versus what's already been taken under contract. And in this market frenzy time over here, we had way more homes under contract than were available for sale. There was like nothing available ever. Let me see if I can make this a little bit bigger. So you always had more homes under contract. But now we kind of have the reverse situation where you have more available for sale than are actually under contract. And that is making this number quite a bit lower. So how do we read this number? So the way they describe it is 0 to 20 is a cool market, 21 to 40 is warm, 41 to 74 is warmer, 75 to 99 hotter, 100 and over is a frenzy. And where we stand today, this is for Greater Phoenix altogether, is at 36.5. So according to what I put up on the screen, it is technically a warm market, but this, I don't know that this chart is quite as updated as the daily notes that they put in. And those notes said that the contract ratio was actually at 30. So basically slipping into a cold market. We're getting really, really close. Although this says 0 to 20 is cool, if you're getting into the 30s and 20s, you're kind of going on the cool end of warm. And as I mentioned before, with everything we have going on with interest rates, it surely seems like this is not going to be getting better for us. So we're probably going to continue to see this going down. What's interesting is that this at 36.5, so this is the month of October. If we go back, let's go back here to 2017. the month of October for 2017, we were at 54.2. And then if we move to 2018, we were at 54.2. Interesting how that works. And then if we move to 2019, things started to pick up. So we were at 76. But you can definitely see the seasonality of our market because this shows seasonality. And that every October things start to fall. Well, we're much lower than we were in those past years in this October. And it's not surprising considering all the volatility and what's gone on. But clearly we're at a lower place than we're used to in October, even in normal years. So we'll have to see how things continue, but that's where we stand. And according to the Cromford report, it feels like we are slipping into a cold market all over. So not sure if that will continue. We will find out. I do have one more thing to share with you guys before we go. And let me see if I can get it up on the screen here. And it's just about really comparing last September to this September with a number of different statistics of sales and whatnot. And it's not very pretty. I just have this written out in a Word document, but I wanted to show it so that I don't have to just talk through it. You guys can actually see. For all you visual people out there like me, it helps to see and read as I go. So this September compared to last September, there were 7,174 closed transactions, which is down 36% from September of 2021. New home closings totaled 1,599, which is down 4% from September of 2021. Resale closings, 5,575, which is down 42% from September of 2021. So notice our new home sales is only down 4%, while our resale closings are down 42%. What I think is going on there is you're locked into a contract when you're buying a new home for a long time, right? So those people probably didn't really have an out to get out, whereas resale homes, that's a 30-day, closing. And if people decided to sit on the sidelines, they weren't stuck in these contracts for a long time. Overall median sales price was $462 last September, or is $462, I'm sorry, this September, up 11.6% from September of 2021. So technically we're still seeing appreciation when we look year over year, although we know that prices have come down about 9 to 10% since May. So that is a very misleading thing to look at. Median new home sales price, $517, up 25% from September of 2021. Makes perfect sense. These contracts were done a long time ago. And then median resale home price was $445, which is up 7.2% from September of 2021. So that's where we stand when we compare to September. Again, all of this is not the best indicator because a year ago things were much, much different, and we've seen so much change since May. So of course it's going to show that we still have appreciation, which is great. If you bought your house last year, you still have gained 11.6% according to the median in your home. So that's wonderful. It's, if you bought your house in May, it's probably not looking quite as pretty, but over time we'll get back. Just depends on how long and where things go from here. So that's all I have today, you guys. I hope this is all helpful as normal. If you have any questions, you can always reach out to me. Check the description. I have a link to set up a time to chat, and my contact info is in there. If you want a quick instant home value, I have a link for that. If you want to search my MLS, feel free. That link is in there as well. And I appreciate you all being here. Thanks for joining me live, for all of you who did. And I will see you guys next week with another market update. So have a great week. Enjoy Monday Night Football. I will talk with you all soon.